Happy Tuesday out there, Team 42. It's your skipper here, Darius Dell, to present our macro minute for Tuesday, December 10th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is a topic that is very near and dear to me as someone who's performed seminal work in advancing my former colleague and mentor Neil Howe's fourth turning thesis into the realm of investing. So today's key macro question is, did the fourth turning just get deeper? Our answers are connecting the dots between the outrage that contributed to the tragic murder of United Health Group CEO Brian Thompson by Ivy League graduate Luigi Mangione leads us to two now infamous billionaires that will be tasked with slashing at least $2 trillion of alleged government waste from the federal budget via the unelected and unaccountable Department of Government Efficiency. Our detailed analysis of the U.S. federal government budget indicates that there is, at most, $700 billion of easy cuts to make. Additional cuts beyond that level must come from programs that are incredibly popular from the perspective of the peak demand for populism that we highlight in our seminal Investing During the Fourth Turning Regime analysis: Social Security, Medicare, welfare, Medicaid, and veterans benefits. Those programs, plus national defense and net interest on the public debt, national defense and net interest on the public debt, account for 90% of federal government spending. Deep austerity in an era that demands populism will inevitably advance the fourth turning. Can you imagine the nationwide outrage if, when President Trump's billionaire boys club cabinet removes access to healthcare, housing, and nutrition for tens of millions of American families, many of whom view President Trump as a lifeline to rescue them from decades of economic malaise? Political violence, nullification, succession, and civil war are all possible and probable outcomes in that scenario. And I say that with a solemn heart as someone who is as well versed and well researched with respect to the fourth turning as anyone in our industry. And I starting to connect the dots on something that could look really negative. It's a little bit concerning when you think about someone who graduated from Penn and went to a $37,000 a year, prep school, can be outraged enough at the K-shaped nature of the U.S. economy and all the isms that have contributed to the K-shaped nature of the U.S. economy, whether it be globalism or racism or sexism or some other isms that have all contributed to put the working class person flat on their back, just as they were heading into the prior and into the early phases of the prior fourth turning that ultimately culminated with World War II. So certainly not trying to scare you. I don't think it's appropriate to scare people into subscribing to research. I think that's a really crappy thing to do. But what I do believe you need to do as an investor, if you are an investor and you're concerned about your ability to retire on time and comfortably, and more importantly, navigating the rest of this fourth turning, of which Neil Howe believes there's another 5 to 10 years left successfully, then I highly recommend you invest the $100 it takes to access our Investing During the Fourth Turning Regime analysis vis-a-vis our monthly macro scouting reports. You can access that in our vis-a-vis our Macro Strategist Pro subscription or our Macro Strategist subscription, but that's where that research is housed, and we update that deep dive analysis every month in every macro scouting report. So transitioning to our 42 macro dashboard, as always, a wrap up with a question from our community. This one's regarding sort of in response to my morning note this morning. Says, hi, Darius, always appreciate this sort of big picture commentary. I'm curious why this fourth turning is so bullish for risk assets when the prior fourth turning was the Great Depression. Do you look at markets in the prior four turnings really as the post-1929 recovery and bull market into and beyond World War II? While not as bad as 1929, the 1937 to 42 market period was extremely painful by any other comparison. It was not until 1946 that market seemed to enter a secular bear market. So thanks for thoughts. So I'll start by saying, very good question, excellent question. It's certainly something we've already considered in that deep dive study, of which we analyzed, dozens of long-term economic time series with, data going back to the 1800s to essentially identify, okay, what's the most probable path for things like growth, inflation, monetary policy, fiscal policy. How do asset markets have historically responded to that? And understanding, having performed that deep dive empirical research, we understand that you typically see higher rates of risk asset price appreciation in a fourth turning. In fact, if you look at the median average annual return over the S&P 500 during fourth turning regimes, it's 11%. versus plus 6% for non-fourth turning regimes, so first, second, and third turnings. Specifically as it relates to this sort of, sort of pick the window of time that we're discussing here. Now, when you go back and you look at the last 5 years of the prior fourth turning, so the 5 years ending in 1946, we had an average annual return of the S&P 500 of plus 13%, which compared to an average annual return of plus 6%, throughout all years throughout the history of the S&P 500 index, of which we have data going back to 1871 for. So almost a double relative to the baseline plus 6% average annual return of the stock market that you saw in the 5 years leading into the end of the last four turning. And another reason, so the key takeaway is that, we typically have higher risk asset performance in these four turning regimes, but we also have significantly higher volatility. If you look at the max min range or the interquartile range of those returns, those average annual returns, then what you typically see is a wider range of max min, wider interquartile range, which ultimately means there's a lot more volatility. So you have faster upwardly sloping, you have higher, positive slope in terms of the price appreciation you see in asset markets, but you also have significantly more volatility risk managed along the way, which in our opinion, really, forces investors to acknowledge that this is going to be a very difficult, challenging time in the years ahead to risk manage as an investor. You're really going to need to lean on, sophisticated, accurate, risk management overlays to guide you through that. I'm not saying that we're the greatest things since sliced bread, but I do believe our KISS and Dr. Mo trend following systems are set up to demonstrably outperform anybody that thinks they can predict all these wiggles and turns and high volatility, just using their fundamental frameworks alone. I think you need to be doing some kind of drug if you think you're going to be able to navigate a fourth turning just using your fundamental frameworks alone. So we're really proud of the trend following elements we built into our research process. We, myself included, we have thousands of investors relying on them to retire on time and comfortably, and getting our portfolio from today's starting point to the end of the fourth turning and into the next American high will be one of the most important tasks of those risk management systems over the next 5 to 10 years. So super proud of that. Really proud of the thoughtfulness of the questions we continue to get in our community of investors. We have CIOs and portfolio managers from some of the world's largest and most respected asset management firms here, interacting with investors on Main Street, mom and pop retail investors, kind of all trying to get to the same place as it relates to retiring on time and comfortably, or helping their clients retire on time and comfortably. And I'm really grateful to be just a part of that, this wonderful community. So we'll wrap it up there. Darius Dale presenting our macro minute for Tuesday, December 10th, 2024. Everyone have a wonderful day out there. Best of luck. And hopefully if we jogged your mind and jogged your interest in some of this, some of this analysis, I highly recommend you review the investing in a fourth turning regime analysis. I'm not even inviting you to remain a client of 42 Macro. Like I said the other day, 100% of our clients can cancel anytime without penalty, and that will be the case until I die or until we no longer have the business. And so, and that's to align our incentives with the incentives of our clients. So hop in, come check out the research, and if you like it, stick around. If you don't like it, go back to doing whatever it is that you were doing. So have a great day. Cheers.